In this last video, we're going to look at notes receivable and interest revenue. So notes receivable, remember it's a little bit different from accounts receivable because it usually involves a promissory note and interest. So a promissory note, it's just a fancy way of saying an unconditional promise to pay. So it's a promissory note is an unconditional promise in writing to pay on demand or at a future date a definite sum of money. So a promissory note, for example, is created when you sign your mortgage, when you buy a house, or when you finance your car. So here's an example of an example promissory note. So it says it's for $200,000. It's dated July 10th, 2021. So it says 1 year after the date, Pacific Rim Corporation promises to pay to the order of First National Bank $200,000 plus interest computed at a rate of 6% per annum. So here we have a maker and a payee that both need to be present for a promissory note to exist. So the maker is the person who signs the note and promises to pay, so the one borrowing the money. So the maker here is Pacific Rim Corporation. The payee is the person to whom payment is going to be made, so the person lending the money. So here the payee is First National Bank. So remember, notes receivable, it's one way in which it's different from accounts receivable is that it involves interest. Here the interest rate is 6%. So what is interest? Interest is the cost or the charge for borrowing money. We can't borrow money for free most of the time, right? Unless we're lucky. So interest is the cost of borrowing money. The borrower, in this case Pacific Rim, they will incur interest expense while at the same time the lender or First National Bank earns interest revenue. So interest expense to the one is interest revenue to the other. So how do we calculate interest? So interest is going to be the principal amount of the loan times the interest rate times the portion of time that we're talking about. So most of the time interest rates are going to be stated annual rates unless otherwise noted. So unless they tell you, hey, this is a monthly interest rate, you can assume that the interest rate is an annual rate. So the 6% here is an annual interest rate. How much interest would be needed, how much interest would be paid for a full year. So let's take a look at some examples. So it says that assume that on December 1st, a 3-month 6% note receivable is acquired from a customer, Marvin White, in settlement of an existing accounts receivable of $60,000. The entry for acquisition of the note is as follows. So in this case, Marvin White didn't pay the accounts receivable by the time it was due. So in this case, Marvin White made an agreement with the company to said, okay, well, can you give me some more time to pay it off? I'll pay you interest, and they came up with an agreement. So here we're converting that accounts receivable to a notes receivable, and we would simply move the $60,000 from the one account to the next. So we would, in this case, debit note receivable or notes receivable for the amount that we're converting now from a regular accounts receivable to a notes receivable for Marvin White, and we will credit accounts receivable for $60,000. So we moved it out of the accounts receivable account into notes receivable. All right. And here Marvin White has agreed to pay it off within 3 months plus interest, and he's paying 6% on that note. So that was on December 1st. Now on December 31st, the end of the company's fiscal year, the interest earned to date on the note receivable should be accrued by making an adjusting entry. So in this case, although Marvin isn't paying them back until the end of month 3, as time goes on, the company still earns interest revenue and Marvin still incurs interest expense. So the total principal amount of the loan is $60,000 times the interest rate of 0.06, so 6%. But the $60,000 times the 6%, that's $3,600 of interest, but that's for a whole year if the note were to be held onto for an entire year. So this isn't for an entire year. So this is just for a month. So from December 1st to December 31st, only 1 month will have passed. So we want to find out what 1 month out of the 12 months of a year, how much 1 month of interest would be. So there's two ways that you can do this. You can take that 3,600, which is 6% of the 60,000, divide it by 12 for 12 months, and times 1 for 1 month to get 300. And that's per month. Or you can find out what 1/12 is. So we would do 1 divided by 12 for that time factor, 1/12, and then times that by the 60,000 times 6% to get that same $300. So bottom line here is 1 month of interest on this note is $300. So the entry that the company would have to record is this interest revenue that has now been earned. But we haven't received it yet, right? Because Marvin will have to pay the $60,000 plus interest at the end of 3 months. But now we're making an adjusting entry to record this interest that has been earned. So interest that has been earned but we haven't received yet, we will call interest receivable. So we will debit an account called interest receivable for $300, and we will credit interest revenue for $300. Okay, so he hasn't yet paid it anything off yet, but we have to record that interest revenue. So for this, to simplify our illustration, just to illustrate the concept, we're going to assume that this company makes adjusting entries only once a year at year end. So we're going to assume that for January and February, those next 2 months that the note will not be paid off yet, that no entries were made in January and February to record this entry here of interest revenue for those 2 months. So given this assumption, on March 1st, because remember the note originated on December 1st, so December, January, and February is how long the note would have been held. So that means on March 1st, the note would mature and Marvin White would have to pay the amount in full plus interest. So that's when the note matures. And what would that entry look like? Well, Marvin would have to pay the principal amount of the loan. So let's do the math up here. So Marvin would have to pay the $60,000. That's just the amount of the note. But he would also have to pay interest. Remember we said there's $300 a month of interest that the company earns, but then Marvin White would incur. So there's $300 a month. But how long was the note? It was a 3-month note. So $300 times 3 is $900. So there's $900 of interest that Marvin would have to pay. But remember, of this $900 of interest, $300 of it was already recorded as interest revenues. And so we recorded also an interest receivable. There's $600 of it, however, that has not yet been recorded as interest revenue. So when we make this entry, what would that look like? So the first thing is, how much cash are we receiving from this customer by paying off this note? We're receiving the $60,000 plus $900 of interest. So we expect to be paid $60,900. So we are going to debit cash for the full amount of $60,900. And we also have to remove the note, because if he paid us in full now, he no longer owes us. So we're going to credit the notes receivable here for $60,000. But then remember, we have to reverse this interest receivable because now we've received it finally. So we're going to credit the interest receivable account for $300. And of the total $900, $600 of it hasn't yet been recorded as interest revenue. The $300 of it already has. But now we have to record the interest revenue that hasn't yet been recorded, and we have to credit interest revenue for that $600. So when this note is finally paid off, we're going to record the debit to cash for the principal amount plus interest, remove the note by crediting the note receivable, and then credit the interest receivable from the end of December, and then credit interest revenue for the amount of the interest that has not yet been recorded as revenue. Now, what about note defaults? What happens in that case? So if someone defaults on a note, that means that once the maturity date of the note comes around, they never ended up paying. So when that happens, the company will then just convert the note receivable to an accounts receivable. But the amount that they move to accounts receivable will be the full amount, the principal amount of the note, plus any interest that has accrued on the note that the customer owes. So what would that look like? So let's take a look at an example here. So here, the principal amount of the note was $20,000, and by the time that it matured, the interest accrued on that note was $1,500 as an example. So when someone defaults on a note, we would take that full amount of the principal plus interest accrued and move it to an accounts receivable account. So in this case, we would have to debit accounts receivable for $21,500, credit the notes receivable, remove that notes receivable off of the books, and then we would have to credit the interest receivable of $1,500 to move all of that to an accounts receivable. And at this point, the company might just leave it there or eventually write off this accounts receivable, or they might take legal action to actually collect on that amount that is due. And then finally, financial analysis and decision making. So we learn about another financial ratio here, and it's accounts receivable turnover rate. So we already learned about inventory turnover, so now we're learning about accounts receivable turnover. So to calculate this, we take net sales for the year and divide it by average accounts receivable for the year. And really, this turnover rate evaluates how efficiently management has been granting credit to customers to generate revenue. So you want the turnover rate to show that the company is actually quickly collecting on debts, because if management just extends credit to any customer, you're probably going to end up having a poor turnover rate and not collecting on a lot of your receivables. So if management is good at determining who to grant credit to, then they will likely see a better turnover rate as a result. So if they are efficient at granting credit and effective at granting credit to the customers, to only the customers that they should be granting credit to, then they'll see a better turnover rate as a result. And just like with our inventory turnover, we can convert the accounts receivable turnover rate to an amount in days. So we can figure out, okay, if this is our turnover rate, if it's 5 times a year, how long on average, how many days on average does it take us to collect a given accounts receivable? So to find that, you would just take 365, the number of days in a year, and divide it by the turnover rate. And that the amount of days it takes to collect on an accounts receivable tells us how liquid the company's accounts receivable is, how quickly it is able to go from accounts receivable into cash, how easily it is converted. Okay, so this is also a judge of a company's liquidity at the end of the day. So that is that for Chapter 7.